Welcome to Strato Income. We're here to help you make money. I want to talk to you guys because what happened to me on Friday, December the 18th. It was definitely one of the most interesting day in my life in trading options. So I want to share that story with you guys. And I know a lot of you guys here have been trading options. So hopefully this video can be helpful to you. If you like it, make sure to subscribe and click the like button. And if you have any questions and the comments, please comment down below and I will make sure to respond to those. So without further ado, let's first start saying trading option is very risky. I know a lot of people here have made money trading options this year. The option volume has grown significantly higher this year because of the lot of the retail trader coming to the market trading options. But I have to emphasize and I have to tell you that trading options is risky. We had this Robinhood kid who killed himself because of trading options. And I almost experienced a similar story, not to that extent, but a very similar story to that kid. So I wanted to make sure to share that story with you, and hopefully this can be helpful. So let's start by talking about some background. On this October 28th, contracts set up. So one is on the SPY, the other one is on the XBI. So SPY is the S&P 500 index, and the XBI is really the biotech index. So what I did basically is I opened two contracts. I sold two bear call spread. And the bear call spread is basically a bearish call spread. And the fact that if the stock expires below 355, I can walk away with the premium. So basically, in short, I have two legs on this strategy. One is 355, the other one is 360. And then from the XBI side, I did Ion Condor. And again, on the call side, I also have a 145 as protection, and a 130 is really where I sold my cost to whoever buying my call. So basically, what does that mean? Option is basically a contract. And somebody who is buying my option contract can have the right to exercise and get 100 shares of SPY from me at 355 price, no matter what the market price of SPY is. And the same goes to XBI. The option buyers can exercise its right and then get 100 shares of XBI from me at 130. And I'm obligated to pay for that. So fast forward to the previous week, on December 17th, Thursday, I received a letter basically saying that, oh, SP and SP 500, which is the SPY index, is going to go ex-dividend on the next business day. So that's Thursday. And Friday, the SPY will have its ex-dividend. So basically, SPY is going to give out dividends for whoever who owns the shares of SPY stocks. And then on that same day, Thursday night, around 12:30 a.m., this is pretty much just Friday morning, I got this letter from TD Ameritrade saying that the S&P SPY contract has been exercised by whoever bought my contract. I'm talking about two contracts of SPY at the 355 call, and then one contract of XBI at 130 call. So someone have exercised those two contracts. So that's basically the background. And what does it really mean? It means that, so what does it all mean on Friday? On Friday morning, I basically have to purchase 200 shares of SPY. Remember, it's because I have two contracts and someone have exercised both two contracts. And I have to get it at whatever the market price it is on Friday morning and give it to that person at $350. per share. This is the contract that I opened, and I'm obligated to provide that and fulfill that contract. So the market price on Friday, SPY opened at 369. Right away, I'm talking about $2,800 lost because of those two contracts. And the same goes for XBI. The market price of XBI at the opening day on Friday was 146. So I have to provide 100 shares of XBI at the loss of $1,600. So in total, I would lose $44,000 right there, right away. And the worst case is that if I don't have enough buying power in my account, I have basically will get a margin call, and TD Ameritrade would have to liquidate all my positions at that day on Friday in order to fulfill my obligations. So you can imagine how big and how risk trading option is. And you can really feel how terrified I was at that time. So, but the good thing is I have the other leg of protection. Remember I mentioned earlier, I protected myself with the SPY at 360. That's the protection leg. And for XBI, I have a protection leg at 145. So I had to pick up my phone right away, call the TD Ameritrade representative, and they helped me to execute both of those, get me out of this shit show. They closed the contract of the protection leg on both of those, and I walked away with some loss. Instead of the $44,100 loss and the potential risk of margin call, I lost a couple $1,000. So my day trader buying power dropped to 103K, and then my cash sweep vehicles, basically the amount I'm owing to TD Ameritrade, dropped to $3,000. So I really wanted to share this lesson with you in the sense of trading option is risky. And if you don't have the protection, if don't know what you're doing, you will lose a lot of money. So with that being said, what are the specific lessons you can learn from this? There are 4 things. 1, the short leg of the spread can still be assigned. It's not like you have a call spread and then you will be totally safe. Even in the Iron Condor case where I had XBI in the Iron Condor, one of the short leg is being assigned and somebody decided to exercise. And this can happen even after the market close. I did not get an assignment during the Thursday market hours. I got an assignment after the market close on Thursday. And this could happen even after the market close. I did not get assigned during the market hour on Thursday, but after hours. Number 2, ex-dividend date is really important. And I have to emphasize this is really important. I would not get assigned because somebody wanted to exercise their contract. On Friday, SPY is giving out dividend. They want to own 200 shares of SPY so that they can be eligible to get the dividends from SPY. And the same goes for XBI. XBI actually pays out dividend on Saturday. So during those days, when you get those letters from TD Ameritrade, definitely, please make sure whatever you need to do, please pay close attention to those dates. I did not. I almost paid a lot of the price. Had I been more mindful of those dates, I would have probably wrote it early on to avoid those early assignments. And that's actually what I was planning to do on Friday. I was gonna go log into my TD Ameritrade account on Friday morning, and then take my sweet time and roll my 2 contracts of SPY and then 1 Iron Condor of XBI to the next most economical beneficial expiration months. I was going to do that, but I didn't have the choice because I have been assigned. And early assignment do occur. Whatever you need to roll it early. And last but not least, Now this happened to the bear call spread, and it can also happen to the bull put spread. The short leg, the short put leg, and this is there's a lot of alarming cases on that as well. I can post a link in the down below where there's one guy talking about his horrific stories on trading Tesla, lose $30,000 trading Tesla with bull put spread, and the spread width is only $1 apart. I can put a link down there. You guys can take a look. So hopefully this is helpful for a lot of you guys here trading options. And I definitely wanted to share this with some of you guys here so that you don't have to go through those kind of experience like I did and like a lot of other people did. And we're in the same community, and hopefully we can help each other. And with that being said, next week let's try to be safe. Let's try to be smart. And I'll see you in the next video.